All right, let's jump right in. Welcome to this explainer. Today, we're treating this like an exclusive masterclass. I'm taking off the host hat and putting on my Wall Street mentor hat because I really want to pull back the heavy glass doors and show you how institutional capital actually moves. You see, right now, completely beneath the surface of the market, there's this quiet machine just moving billions of dollars. And it's doing it in a way that most retail investors honestly just don't get. We're talking about a wealth transfer that's going to define the entire next decade. So my goal today is to hand you the exact institutional playbook you need to not just survive, but to absolutely thrive during this massive macro shift. So let's start with a little tough love, okay? I want you to ask yourself something. Is your passive index fund really a strategy? Or is it kind of just a financial surrender that's been dressed up to look like passive income? Look, for the last 15 years or so, the media, the algorithms, maybe even your broke uncle, they've all been convincing you that just blindly buying the S&P 500 and going to sleep is the ultimate path to wealth. Well, I'm here to agitate your comfort zone today, because that set it and forget it strategy, that is exactly what the smart money is silently rotating away from as we speak. Here's the roadmap for our masterclass today. We'll start by unpacking the S&P 500 trap, then we'll move into reading the macro weather. After that, I'll give you the institutional playbook. We'll dive into some specific sectors in picks, shovels, and power, and we'll wrap up with the absolutely crucial part, discipline over emotion. Okay, part one, let's get right into this S&P 500 trap. We absolutely have to start by dismantling a massive illusion out there, the illusion that index funds automatically give you true diversification. Ready for a wild number? 40%. Right now, just 10 mega-cap tech stocks make up literally 40% of the entire S&P 500 index. Just think about that for a second. Out of 500 supposed companies, a tiny little cluster of 10 controls nearly half the weight. Guys, we haven't seen this level of dangerous market concentration since 1972, right in the thick of a massive oil crisis. So when you buy the index today, you aren't actually properly diversified. You're just making a heavily concentrated bet on a handful of tech giants. In this concentration, it creates a really dangerous trap. There is about $13 trillion sitting in US ETFs right now, and every single dollar of that passive money automatically, blindly, buys the biggest stocks. It creates this crazy, self-reinforcing flywheel. The big just get bigger mechanically, not because they're necessarily better values today, but simply because the system literally forces billions of dollars into them. Now, sure, that works beautifully on the way up, but man, it acts like a violent trapdoor on the way down. The underlying mechanics of this trap is something called market cap weighting. It's an index structure where the largest companies just automatically receive the largest share of invested capital. It's essentially a seesaw. And right now, that seesaw is completely broken. When the macroeconomic weather changes, and believe me, it is changing rapidly, this heavy concentration is going to violently reverse, and it's going to drag all those passive investors right down with it. Which brings us to our second point, reading the macro weather. In this game, your job is not to be a meteorologist. You don't have to predict the weather perfectly. Your job is just to dress appropriately for the weather you're actually standing in. Look at the stark contrast between eras. Remember the 2021 era? We had zero interest rates, abundant liquidity, and pure speculation was heavily rewarded. You could literally throw a dart at a board and make money. But our 2026 reality? It's fundamentally different. We are facing structurally sticky inflation, deep geopolitical conflicts, and massive physical infrastructure needs for AI. We are just no longer in an environment where everything automatically goes up. Today, what you own matters far more than when you own it. If you doubt that, just look back at the proof from 2022. When the macro weather shifted then, the broader S&P 500 fell 15%. But here's the secret. The money didn't just evaporate. It rotated. The educated money rotated into energy and defense, and those sectors crushed the index with returns of up to 40%. That's the key takeaway here. Money doesn't leave the market, it just moves. It flows to the sectors that have structural tailwinds from the new macro conditions. Moving on to section 3, the institutional playbook. I'm going to hand over the exact, strict system used by educated Wall Street money. It's a simple 3-step framework. Step 1, map the macro weather. Step 2, follow the sector money flow. And step 3, pick leaders on breakout. Now, do you notice something absolutely critical here? We never ever look at individual stocks in step 1. We don't even look at them in step 2. Retail investors almost always look at stocks first, completely in a vacuum. Institutional money, They look at the macro current first, then they identify the winning sectors, and they only look at individual stocks at the very, very end. And as we target those winning sectors, we're specifically looking for picks and shovels. You know the old saying, right? It means investing in the underlying infrastructure, the machinery, and the resources required by a booming industry, rather than trying to bet on the final product. During the California gold rush, the miners took on all the risk. But the guaranteed winners? It was the people selling the picks, the shovels, and the Levi's jeans. That is exactly how we're going to play these upcoming commodity and energy supercycles. All right, let's get into the specifics in Section 4, picks, shovels, and power. We're diving right into some specific under-owned sectors that are receiving massive, massive institutional capital flows right now. Our targeted watch list includes Baker Hughes in energy infrastructure, SQM in critical minerals, and UEC in nuclear fuel. Each of these tickers perfectly, and I mean perfectly, aligned with our macro weather report. They aren't just random stock picks. These companies are literally the physical backbone of the next economic cycle. Let's start by looking at Baker Hughes, ticker BKR. They're the ultimate picks and shovels play for the energy sector. See, they don't actually drill for oil. They make the highly complex machinery that makes the drilling possible. With global energy chains in totally disrupted states right now, they're out there building massive offshore LNG terminals down in Texas, and they're benefiting directly from multi-year infrastructure rebuilds in the Middle East. Simply put, when the world needs power, they go out and buy equipment from Baker Hughes. Next up is SQM. This company is an absolute powerhouse in the critical minerals space. They're one of the top global producers of lithium. And listen, the whole global transition to renewable energy, it's not just about electric vehicles. That's a huge misconception. It's about massive grid storage. Think about it. The sun doesn't shine at night, so you need giant batteries to store that power. Lithium demand is growing at roughly 25% annually, which makes it structurally impossible to oversupply in the current market. And then we have UEC, Uranium Energy Corp. The dynamic here is just fascinating. The biggest tech giants in the world, Google, Amazon, Microsoft, they've all realized that solar and wind simply cannot provide the massive, uninterrupted power needed for their AI data centers. They absolutely need the base load power of nuclear energy. UEC just brought online the very first new U.S. uranium production facility in over a decade, and it's fully backed by heavy government demand to cut our reliance on adversarial nations like Russia. That is what you call a massive structural tailwind. Finally, let's head into Section 5, discipline over emotion. Look, knowing the structure is great, but it isn't enough. We actually have to execute. So let's break down the anatomy of a true institutional breakout. One thing you absolutely need to know, Wall Street does not buy falling knives. They patiently wait. Here's how it plays out. Month 1, a stock builds a base. Month 2, it tests resistance. But it's in month 3, when the price finally breaks out with massive volume, that the smart money moves in. That spike in volume, that's what confirms institutional accumulation. We wait for that technical confirmation before we deploy even a single dollar of capital. And this leads right into a concept that, frankly, most retail investors really hate. It's called the probability premium. Believe it or not, institutional investors actually prefer to buy a stock slightly above its recent resistance level. Why on earth would they do that? It's pure probability math. Paying a slightly higher price on a confirmed breakout is ultimately much cheaper and vastly safer than trying to catch a falling knife and predicting a market bottom without any real evidence. Which brings me to my toughest but most important rule for you today. Maximum risk on any single position must be calibrated to what you can lose. Discipline separates investors from gamblers. You can never, ever let your conviction in a macro trend turn into a reckless, concentrated bet. You must limit your maximum risk on any single trade to just 1% of your total capital. That strict discipline is exactly how you survive the market turbulence, so you can hold on to capture those real structural gains. As we wrap up, I want to leave you with this provocative thought. Every single day, you trade your most irreplaceable resource, your time, for money. And right now, the greatest wealth transfer of the entire decade is actively happening. Capital is rotating out of those passive, top-heavy indexes and directly into the physical infrastructure of the future. So the only question that remains is this. Are you going to keep sleepwalking through this massive macro shift, or are you ready to actually take control of your financial future? Which side of the transfer will you be on? Thank you so much for joining this Masterclass Explainer. Stay sharp out there, and I'll catch you in the next one.